different incentives. First, the use of technological platforms. They started working with a SMS platform called Transfer 2 years ago, in order that people could save in their pension accounts. And recently, they have launched an app named Afore Mobile that is that allows people to open an account, a voluntary pension accounts, also to make deposit, also to check their balance, and many features that are really easy for people who want to participate in the pension system to continue participating. And also they are incorporating non-monetary incentives, for example, improving the reports and personalize them in also with the idea that people also have a clear idea and transparent information and be aware about how to save for retirement. So we see that a combination of commitment of government commitment, regulatory commitment, and the development of digital solution could be a good combination for increasing in the future pension participation in Mexico. Thank you.
Thanks, David. I think that's a nice perspective to have, which is, so it's not only financial inclusion infrastructure, but also using fintech with strong political and regulatory commitment. And I think the fact that we have people like David Bonnier here who've flown all the way from Uganda does prove that there is significant commitment at the regulatory level to actually find a solution. And I think David's been doing some interesting work in this area where the regulators actually step forward to encourage the creation of a micropension market in Uganda. And it'll be great to hear briefly about David's experience in this area and his outlook on inclusion going forward. My only request is going to be that we should look at the next, say, we have about 1, 2, 3, 4. We have another 5 people to speak, and we've encouraged people here to raise their hands and actually participate in the conversation going forward. So let's look at slightly more brief comments initially, and then get into maybe a greater debate. Over to you, David.
Thank you so much, Gautam. In Uganda, the inclusion of the informal sector is what I may call at a developmental stage. The law which exists to enable this is not very certain. We are still working on it. The policy framework isn't very clear. And as a body which is established to regulate the retirement benefit sector in Uganda, we have a mandate to promote the development of the entire sector, besides the actual supervision and regulation. Out of this initiative, we thought we needed to ask some of the group of people in the country who were interested to set up informal sector schemes or micropensions. And we licensed 2 of those last year. One started operating immediately, one is just about to start. And we have seen another one which is coming on board, but yet to be licensed. And we're still working with them to ensure that they are licensed. We wanted to see how it will work in our environment. And we did ask Pinbox to come and look at it from their experience and perspectives, and a lot of lessons came to fore, which we are still working on, and made some recommendations to the Minister of Finance, which owns the policy, to consider for purposes of improving the environment in terms of policy and the law for purposes of better operations. However, this scheme, which we studied, is a simple DC scheme, where people are free to make a contribution of their choice. There's just a minimum of 2,000 Uganda shillings. I love to use the Ugandan currency to make it appear like it's a lot of money. And people make these contributions at the time of when they make the money. That is of their own choice. They are not compelled to make a contribution at any particular given time. Now, the payment mode is through money transfers, mobile money transfers, and the two major mobile money transfers in the country have been registered, and the prices or the cost of transfer has been agreed on. And under the law, all these schemes are supposed to have asset managers and custodians, and those have been appointed by these schemes. Of course, I mention all those things to indicate the cost, which is proving to be high for these small savers. One of the big challenges that this scheme is facing from our study is it is owned by individuals who are not government. It's basically a private charity to do a public function. So which brings to fore the big question of how do they raise money to do the campaign and to run this program. There's already a high cost that we have noted because of the structure. A number of people came on board. In fact, the scheme is about to clock 1,000 members this year. And we do think that a number of those are getting to be dormant, not making any contribution anymore. So one of the things that we think should be able to deal with some of these problems is to have a centralized way of managing these schemes, which is a platform where any other provider of this program can use, and probably owned by government under PPP, to make the cost low. There's a lot of lack of knowledge, and therefore the regulator, which is mandated to educate the public on savings for long term, we need resources to do a lot more of this work for purposes of promoting the need for long-term saving. The legal framework is inadequate, and especially when these schemes are established as trusts, which basically don't give you a lot of room to raise funds for purposes of investing in these products and raising sufficient funds for purposes of doing all the work that is supposed to be done. And a number of lessons which we need to address is the question of capacity to save for retirement. We may blame the environment, the legal framework, but do people have enough money to save is a question, and which brings to fore again the question of incentives on part of government. Should the government do some matching, absorb some of the cost involved in this? Number two is the framework under which they administer these programs. Should the government also buy the software, the platform, so that all these people who want to participate can actually log on to and then run these programs with a reduced cost? What should be the government incentives? These people don't pay taxes, so sometimes we talk about tax incentives. They don't apply in this situation. I think either emerging will be appropriate. Some guarantees in terms of investment earnings will be also appropriate, just to encourage these people to put in some money for long-term saving. And the critical is whether, because these people face a lot of financial challenges in their day-to-day living, and therefore, how do you deal with those immediate financial needs? Should the government be more robust in terms of social protection programs, provide financial access to these people when they are in a problem, rather than just saving for 1 month and then you want to take it away immediately? These are some of the programs which we are considering as a matter of policy and development. And as we conclude this report, we think the government will consider it more appropriately and be able to come up with something which can work better for the informal sector saving in Uganda. Thanks.
Thank you very much, David. So, in fact, one of the things that struck us when we were in Uganda briefly for the study was that while there are indeed challenges around individual micropension providers being able to afford the cost of, let's say, more generic efforts at financial literacy or retirement literacy and promotions and so on and so forth, and therefore being able to afford the cost of public goods. There were also some really interesting positive outcomes of the initiative or the experiment that the regulator launched, which was that a lot of the people who were salaried workers covered by mandatory pension programs were actually stepping forward and opening pension accounts on a voluntary basis with the micropension providers as a way to achieve supplementary savings. So I think there is perhaps some silver lining in all of this, and I think there is perhaps merit in thinking about strengthening these institutions. And I guess from that point of view, a shared infrastructure approach where the government steps forward to assume some of the public good costs could be a good way forward. Thanks so much for your comments. Mr. Mutuku, who is the CEO at the RBA at Kenya, he is another regulator in East Africa who's also made similar initiatives and in actually launching a micropension program. This was done almost 6-7 years ago, and I think there is an interesting story. A lot of you might have heard of the scheme called the MBOW, which is a scheme for Juakali workers, or basically informal sector workers who work under the sun. We'll request Mr. Mutuku to tell us a little more about his outlook on this area.
Thank you, Gautam. I think a lot of what is happening in Kenya is similar to what is happening in the other countries we've talked about, particularly Uganda. But let me just perhaps try to give you some perspective from somebody who is a bit ahead of the others, because as Gautam says, our scheme has been there for a while. It's important just to highlight what kind of system we have in Kenya, because we don't have the advantage of what we had about from New Zealand and UK, where you can use auto-enrollment or use some sort of compulsory system. Our system is really mainly voluntary. Most of the schemes we have are occupational schemes started by employers on voluntary basis. So it's not a must that they have these schemes. And then we have what we call the individual schemes, which are open to anybody, but which again one would join on voluntary basis. So the aspect which is really mandatory is a very small component, and it only captures the formal sector. I think that's a very sort of important background. So in light of that, when you look at the figures, they're quite stark. When you compare with the figures we were seeing earlier from Mexico and so on, you can see our coverage is very low. Out of 16 million or so people who are employed, less than 3 million are actually in the pension system. So the coverage rate is extremely low. And part of the reason for this, of course, is that 80-85% of this employment is in the informal sector. So if you have a system which is voluntary, which is capturing the formal sector, then you're going to lock out most of the members. So, in order to expand coverage, we have tried to put in place the right legislative framework, as my colleague mentioned in the earlier session, and we have really tried to encourage this product for the informal sector, and of course, based on technology. So we have the MBOW, Individual Retirement Benefit Scheme, which is one of the individual schemes we have in the country, but this one specifically looking at the informal sector. It's mobile phone based, and as you heard earlier, in Kenya, we are very much ahead in terms of use of mobile phones for financial inclusion. We use the phones for ordinary payments. You are given the example of taxis and paying for your beer. You can use your phone. Even government the other day issued a treasury bond which you could buy through the phone. So people are very much used to using phone for financial services, so it was very easy for us to use this for the scheme. And the other thing is that these are not smartphones. These are just, what we call feature phones, because the M-Pesa system or the other systems that we have don't require a smartphone. You can do all these transactions using just a basic phone. So long as the phone is able to make a call or an SMS, then you can do that. So the way it works, the way the MBAO scheme works is that, from your phone you register. Again, we have the advantage that we have the ID system in Kenya already. So when one is registering for the mobile money system, for example, M-Pesa, there's already that KYC where they cross-check against the database of IDs, and you're already known to the system. So when you're registering for the pension scheme, you don't need to do anything else because you're already registered for the mobile money. So you just register from your phone, and then you make your contributions from your phone, and eventually when you're being paid, it's also paid to your phone. So it is quite straightforward. And then the scheme just runs like any other scheme. It is regulated by us. It has the fund manager, the custodian, and the administrator, and so on. The founder of the scheme is the sort of worker groups, one of the informal sector worker groups. So it's not founded, just like David said, it's not founded by government or by RBA. It is founded, it's a private scheme, basically. And the scheme has grown quite well, currently around 76,000 members, but I think overall around 100,000 or so people have passed through the scheme. So what really have been the challenges, given our experience with this scheme for all these years? I think, as was said also earlier, these workers have irregular income, their incomes are low, and they have a lot of other priorities. It's not easy to convince somebody to put money aside for retirement when he's struggling to pay school fees, or he has medical expenses and so on. It is a challenge. In the list of priorities, it is not likely to be up there at the top. Secondly, getting them to join is one thing. Getting them to stay is another thing, as David said. And our pension system as a whole, we have a problem of withdrawals, because we do allow people to access quite a lot of the money before retirement, for example, when they change jobs. So somebody is working in one job, move to another job, they're able to access, even though they have not reached retirement. And what is left, perhaps, is just a smaller proportion. So that culture of withdrawing from pension schemes is already there, even in the formal sector. So now you can imagine the informal sector trying to get somebody to keep the money in the scheme until retirement age. It is quite a challenge, and we have seen quite a lot of withdrawals from the scheme, particularly when emergencies come, and it's also tied to what we discussed earlier, that it's not packaged together with insurance. So if you have some kind of risk event, you may want to get your money out of the pension scheme and use some tricks to get it out to address that event. Inconsistency and lack of sustainability is a big problem. If you think it's difficult to get people to enroll, getting them to contribute every month is also much more difficult, because in the beginning they think it's a good idea, they put in their money, but now next month something else comes up and then they don't put in. So in our voluntary system, where you don't have payroll deductions, it's very difficult to maintain sustainable contributions. If you compare with other individual retirement schemes, which are also voluntary, the difference is that in those other schemes, the person joins voluntarily and gives instructions to his employer every month, deduct this amount, and he forgets about it. But in this scheme, you have to go to your phone and make an active action to send your contribution every month. So that is a key difference, and that is why you find people start with a lot of enthusiasm, they make contributions, but over time you find them tapering off. We have an issue, of course, of other savings vehicles which are there. So even when someone genuinely wants to save, he has to choose between this route, which is the pension scheme route, and other routes. We have particularly what we call the SACCOs or credit unions, which are very big in Kenya as well. These have an advantage over the pensions product in the sense that they offer credit. So you save through this vehicle, and of course these vehicles are also adopting mobile technology and so on, making it easier for people to save. But as you save through these vehicles, you are able to access loans and so on, which you don't get from the pension scheme. So even though somebody is saving for his retirement, he may find this other vehicle more attractive because of that possibility of getting credit in the future. Now, there may not be as tax incentivized as pensions, but I think, as David said, a lot of these people are not in the tax bracket. Of course, there is a benefit because the investment income for the pension scheme is tax exempt, whereas for other vehicles they may be paying tax on the investment income. But the investors may not be so sophisticated, and they may opt to go where they will get this value addition of credit. For our scheme, as much as it's having this mobile-based platform, it's not so robust as you would like. For example, it doesn't offer you real-time balance. The pensions industry is designed as a long-term industry, so even for the other schemes, they don't give their members, real-time balances. They normally give their members statements every quarter or maybe monthly, because the members don't want or need to know what is the balance every day. They contribute on a monthly basis, and at the end of the quarter, they get their statements, and they're happy with that. But in this scheme where you're making somebody, contribute, trying to get him to contribute as often as possible, everything is on the phone, you would also expect to get his balance whenever he wants it, which the system is currently not able to do. But that's something which can be solved through work by the managers to, maybe unitize and also having the right platforms and so on. There's questions about really the financial sustainability of the program. Sometimes it is perceived more as a CSR program by some of the players. If you look at the fund manager, the administrator and so on, they tend to see it not so much as something which they are doing because of the benefit, but something which they are doing maybe for the name and so on. But of course that will change if we are able to get much larger numbers on board, because when it really gets big and the amounts are huge, then it will become more viable. And then lastly, I think, as has been mentioned, marketing, this is very difficult. When you have a voluntary system, you need to keep reminding people to contribute and who is supposed to meet these costs. My Rwandan colleague mentioned that they want to do a big launch with the Prime Minister and so on. But even after you do that big launch, somebody has to be there to, that big launch will give you good numbers to enroll, but as you go ahead, somebody has to be there to keep doing constant marketing, otherwise it doesn't maintain the sustainability. And I think that is what we may want to discuss with government, so that maybe government takes this role. This PMU office we're talking about, perhaps if this is something which is driven by government, then that role can go to them. Thank you.
Thank you, Mr. Mutuku. Okay, so I think we are currently running behind time, and I've been encouraging the other chairmen of other sessions to be very strict on time. So I think I am going to fail miserably. Please do not use this as an example of how the subsequent sessions are going to be running, Will Price included. Okay, so we'll request Governor Arawa to tell us a little about what is really unique about the efforts that are currently underway in both Solomon Islands and Fiji on increasing pension coverage, and what are the specific challenges that you think you're facing? I mean, we're seeing a lot of commonality across, some of the challenges that have been discussed already. But is there something which is more unique and which we've not heard about yet specifically? That would be very interesting.
Thank you, Gautam. In the interest of time, I will just be very brief. The Solomon Islands pension inclusion reform is part of our national financial inclusion efforts strategy. We are now implementing our second financial inclusion strategy, and in that one of the key result areas is to introduce a voluntary scheme, especially for rural areas and where there's a very high rate of exclusion. And if you break it down into gender, our women have a higher rate of exclusion. So we've introduced a pilot scheme early this year with a Provident Fund, encouraged informal and voluntary savings. And to date, that scheme has, well, the intention is to pilot this project and roll it out if it's successful. To date, that pilot has been very successful. And I just heard from Krishnan, Provident Fund has now decided to roll that nationally. And so some very interesting trends or issues have come out from that pilot. One is women really have joined that. 60% of the members are women, which is very positive for us. And also we've seen high rate of people over 50 are joining that pilot scheme. So I think it's we're achieving what we're trying to achieve. But of course, we have challenges in the country. One, for example, we don't have a national ID scheme, and the telecom coverage is an issue. But these are challenges that we will address. I think the only other point I want to mention is in terms of regulations. We've taken the approach that let the market roll out the products and services, and regulations will come later. So that's an approach that we have taken, and it has proved successful in our case. So I'll stop here. I want to tell you a story about a lady called Ruth. She's 43 years old. She's been selling peanuts in the market for the last 20 years, trying to get a bank account, couldn't because there's no identification, documentation of identification. She joined the scheme early this year, the pilot scheme. Now she's saving, she's earning interest, and that saving, she plans to build a house for her family. So that's hope we'll get more roots to join the scheme, and I'm sure it will be a successful for us.
Thank you so much. Thanks for your comments. So we now have two more panelists before we get into a broader discussion. I'll first request Kamer, who's been involved with the very interesting work that's happened in Turkey, which I think also did involve automatic enrollments and was done in an incredibly short period of time. And it'd be great to hear what led up to this reform in Turkey and any insight on where things currently stand and how this could go forward. Over to you, Kamer.
Thank you. Okay, I think my intervention, my remarks will be quite different than the previous panelists because as you asked me to, I will take a much more aggregate look at the motivating factors because in Turkey, in the Turkey experience, in addition to the specific aspects of the pension scheme itself, you know, the existence of a large Pillar 1 and the absence of a voluntary scheme, what led the policymakers to actually reform the already existing scheme, voluntary scheme, was actually motivated by the macro challenges of the growth process. So in 2001, Turkey had a major economic crisis which led to a series of reforms. Very quickly after 2002, Turkey entered into a growth episode of over 6% growth, average growth rates. But during this growth episode, Turkey started experiencing a widening external deficit. So if we look at this external deficit from another perspective, this is in fact a gap between the country's savings and investments. So this was what we were asked by the government. So I was working at the World Bank Turkey team at the time. We were asked by the government of Turkey to work on the savings issue in Turkey. So we actually had a joint study with the Ministry of Development to look into why and how Turkey's savings rates are low. So this chart shows the declining saving rates. The columns, the bars are the total saving rates. So this is based basically on national accounts. Saving rates are coming down in 2000s, particularly after 2002, I think. And the lines that you see, the different two lines, represent the private and public sector savings. So the reform efforts that I mentioned after the big crisis led the public sector to have a major fiscal consolidation, which increased public sector savings. But in parallel, the private sector savings declined. That's the red line that actually was behind the declining total savings. So this I already mentioned, the saving investment gap has been declining and Turkey running external deficit. So why was this important? This was important because of two factors. First, clearly, the countries need savings to finance their investments, and Turkey, being a developing country, needed higher levels of investment. And secondly, in the absence of domestic savings, the country had to rely more and more on foreign savings, but this created vulnerabilities. So beyond savings financing investment fact, there was also this vulnerability problem. So as long as foreign savings are available, external funds flow in, there seems to be no problem. But the moment when the foreign inflow stopped, and Turkey went through this episode as well, then financing investments would become a problem. So in our analytic work, we try to get a sense of where savings should be in order to finance Turkey's average growth rates of, say, or targeted growth rates of 5-6%. We took 5.5 as an example. The result we got was basically Turkey's saving rates would almost need to be doubled from 14-15% to 30% in the long run. Now, of course, I've been talking about aggregate saving rates, but to be more policy relevant, we had to break this down into different components. And the most relevant for today's discussion is, of course, household savings. And I think other panelists also refer to household saving patterns, especially the lack of savings for informal sector workers. So when we looked at the components of the private savings, we concluded that the decline in the private savings, that was the red line in the graph, was actually driven by the decline in household savings over this period in the 2000s and after even 2010. So the other parts is, of course, of the private sector savings, the corporate sector. We focus more in our work on household savings, and we try to understand why households are not saving or have reduced their saving rates, and try to understand the pattern in their savings behavior. So this is a chart that shows the breakdown of Turkish household savings. And of course, this is the financial assets. So first, I have to mention to you There is a wide pattern of non-financial savings. In other words, people hold other kinds of assets, such as gold, for example. So we call these under the mattress savings. And of course, it is difficult to estimate the amount of this non-financial savings, but when we just look at the financial part, about 3/4 of their savings are in deposit accounts, either domestic currency or foreign currency. And the other components really take up very, very small shares. And in this graph, this is 2016. For example, retirement funds, pension funds are only 6% of the total. So when we did focus group discussions with households, we saw that they don't save regularly, and they have also some misperceptions about the products available to them, particularly on the private pension scheme at the time. This was done some years back in 2011-12, so before the major reform changes to the pension system. When people entered, this was something which I thought was quite interesting. When people entered the private pension scheme, they signed up, and they exited early. They faced a penalty, and going into the scheme, they didn't realize they would be facing a penalty. So when they did have to pay this penalty, they thought the system was not reliable, or they were not treated fairly. So this was the sense that they had. So I think financial literacy played an important role in people's behavior towards the pension scheme. And on the basis of this, of course, there's a chapter in the book which you can read on the details of the reform, but there are a number of changes to the scheme. Do I still have a minute or two? So this system was introduced in 2003, and it grew rapidly, but the government was very keen on expanding it further. So in 2013, they introduced amendments to expand coverage, and the major change was to replace the tax relief, which required action on the side of the participant, to a direct state match, a 25% state match. So this is really addressing the problem of people not really taking up the tax relief, because in the this tax relief period, only 1/3 of the participants were using this incentive. The fee caps were reduced, for example, on the administration fee from 8% to 2%. And at the end of 2016, the number of participants grew significantly to 6.6 million, and the assets under management grew to $17 billion. But again, this was still not where the system was expected to be, and auto-enrollment came into the picture very recently. The legislation was introduced in 2016, in August 2016, and auto-enrollment became effective in